Good afternoon and welcome to the PHAROS Energy PLC Preliminary Results 2021 Investor Presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time via the Q&A tab situated in the right-hand corner of your screen. Simply click Q&A, scroll to the bottom, type your question and press send. The company may not be in a position to answer every question received during the meeting itself. However, the company review all questions submitted today and publish responses where it's appropriate to do so. Before we begin, we'd like to submit the following poll. I'd now like to hand you over to Mohammed Sayed Ahmed, Group Head of Technical, Sue Rivett, CFO, and Jan Brown, CEO. Good afternoon.
Thanks very much, and good afternoon, everyone. Thanks for joining us. 2021 was a year where we absolutely hit the ground running and did not stop all year. It was a year of resetting the dial on a number of different fronts for the company. On the operations side, we met production guidance. We had the most extensive drilling campaign in Vietnam since 2017, which has maintained our production levels. And, oh, sorry, I forgot. I'm the one that's supposed to be doing the slides. Apologies. There we go. We had the most extensive drilling campaign in Vietnam. It supported the production levels there and also provides the backdrop for a license extension that Mo will talk to you about in his section. In Egypt, we had encouraging results from the development drilling that started at the back end of the year with 2 wells completed into 2022. Again, Mo will talk you through these. And on North Penny Swift, which is our exploration block in Egypt, we have identified low-risk drillable prospects. Finally, on the operations front, Block 125 in Vietnam, we've shot the seismic. The processing is underway, and we'll be looking for a farm-out partner for the well, which is a commitment to be drilled before November 2023. Probably the most important area of focus for us last year was on the value front. And first off, we negotiated improved fiscal terms for the El Fayum concession. Sue will walk you through the detail of these in her section, but fundamentally this means 20% higher revenues coming to the contractor on every barrel sold. And then probably most important, we signed the farm-out transaction with IPR. That deal provides the funding to monetize the 2P reserves. Our 45% share of field costs is carried through 2022 and beyond. And all the while, we will receive our full 45% share of revenues. Again, Sue will walk you through all the detail on these really important value enhancements. On the corporate side, last January, it seems a long time ago, we raised a small placing and carried on adding to the liquidity that had been so challenged throughout the downturn in 2020 by refinancing our RBL over the assets in Vietnam. We reorganized our staffing base in the UK. We're now a leaner and more focused organisation with cost reductions coming through there as well. And as a result of the completion of the IPR deal announced last week, the board is being slimmed down. And of course, the operations in Cairo will also be slimmed down. So it sets us up for a far more positive 2022, a year where we return to free cash flow generation. And I will pass to Sue to tell you all about the cash side of things.
Thanks, Jan. So just to let you know, so Sue Rivett, I'm Chief Financial Officer. I took over in July of last year. I've been with the company for about 6 years, so I have a little bit of history with that. I've also been in the industry about 40 years. That gives you my age, I think. So I'll move on to the 2021 financial results, starting really with the production, as that drives most things, as you're well aware. So just under 8,000 barrels of oil equivalent per day there, down on the prior year, largely a function of the Egypt production falling off there. As you know, we curtailed all of our drilling activity following the price crash in March 2020. So Vietnam stable and in guidance, but Egypt coming off there as a factor of no firm investment. In terms of the revenue numbers, about 164 million versus 118. That's prior to any hedging losses and gains. I don't propose to go through all of these, but just to mention a couple more. So the cash OPEX, as you'd expect, up on a per barrel basis, driven mainly from the decrease in the production numbers there. The absolute numbers are up slightly, so 48.3 to 52. That's really a function mainly of the FPSO, where we share the throughput with Tang Long, and our throughput was higher than theirs for the period. In terms of the balance sheet, so roughly the assets valuing there at just over 300 million. And of course, as we sit here today, as you're aware, the market recognises only about half of that. And moving on, okay. In terms of the 21 cash flows, so we started the year with 25 million, finishing with 27. There's a number of things obviously rolling in there and out. So operating cash flow 10.8, and I'll pick up on that in the next slide. In terms of the investment program last year, just under 42 million. So Vietnam, we went back to a drilling campaign, so 4 wells on TGT there, and on block 125, as Jan mentioned, the commitment 3D seismic being shot. In Egypt, it was very much that going back to some kind of program, so the water flood, and then onto a 3-well program that we'd signed up for. Also, things to note in the slide there is the financing activities, so coming in and out, that's the RBL renegotiation and National Bank of Egypt, where we have a small facility there to help our facility. And also just mentioning there the placing 10.9, that's after costs. And if I move to the next slide, so net debt in focus really, so 32.6 versus finishing at 57.5. Just picking up on that operating cash flow of 10.8, 60 million coming in from operations there, and unfortunately some government taxes being paid there. And the rest is the working capital, mainly focusing on that element. So that's that's probably enough on that slide, and I'll move swiftly on. So really the balance sheet, everything was about strengthening the balance sheet for last year, very much picking up on the themes that Jan mentioned. So the equity placing, those improvement in the fiscal terms in Egypt, which were really important to us. So 20% increase in revenue take. The RBL being refinanced in mid-year, and that pushing the tenor of that out to July 2025. Very important in our liquidity position. Also, the National Bank of Egypt, we have a facility there of up to 20 million. It's based on up to 60% of the Egyptian revenue invoices can be pulled upon, and that gives us a little bit of protection there, political protection there, should EGPC not pay in accordance with terms. And also, of course, resetting the dials, the overhead reduction, so about a 50% reduction in the London head office, a board restructure, and also the Egyptian team will now in the process of restructuring that following the completion of the farm down. And if I could pick up on hedging, always an important subject. So we hedged for 2 reasons. One is because of the RBL, so we were required to submit 35% of our Vietnam volumes under the RBL facility, and that's the RBL is only over Vietnam assets, so Egypt free floats. On the table on the left hand side there, you'll see the green swathe, and that's getting wider, and basically what that means is that we can float further with the price, whatever the price is doing. We've hedged probably higher than we would like to in the first half of 22, mainly a function of stress testing in very low commodity prices. So we tend to stress test down to sort of $35-40 basis, and obviously that will force you into sometimes taking a position there. But as we move forward, that gets wider and should enable us to take float with the market. And if I could concentrate on Egypt, so very important elements. So Jan mentioned the fiscal terms, so that improvement for roughly 20%, that's very important to us, but also to IPR, our new partner, as they come in. The deal itself, a small cash consideration, 5 million, 2 million was received last year, with 3 million to come in any day. In terms of the carry, this really was the prize, so it means that we can get back to an investment program and get after more production in that area. So it's not only a carry on capex, but it also includes opex costs and G&A, so 33.5 million. There's also an adjustment period between the effective date, which is 1st of July 2020, and indeed just the other day. So there'll be a catch up, which will also be added to the carry. So as you can see, we will be funded fully through 2022 and into 23. Also a feature of the deal is the contingent consideration. So anything above $62 up to $90.5 a barrel means that we could earn up to 20 million over a 4-year period. Obviously, as we sit here today, we would expect to recover the full amount. So just to give you an illustration for the rest of 2022, effectively that table there just showing you the revenues that we would get in based on last year's production. We haven't given any guidance this year on the Egypt production until we see the impact from IPR coming in, and I believe we're able to do that at the AGM. So full money in there, but no costs going out. So as we move forward, 1.2 million of our own operating costs per annum and some exceptional restructuring costs there. And then I'll just move on for me to wrap up. In terms of 2022 cash capex, we would have forecast around the 50 million, but we will be carried from now on through the rest of the period. So that brings that capex spend down to 28 million, which effectively is the 2-well program in TGT in Vietnam, 1 well in CMV, and very much the long lead items for the well that Jan mentioned, commitment well on 125 next year. So key considerations: revenue inflow, modest costs ourselves. There is a catch up on the royalty payment and some deal fees, obviously. Vietnam, very much low break evens at $25 a barrel, and very much a reduced base office costs right the way through the organisation. So that will get us back to capital allocation, and particularly in these high prices, where we spend the money and whether there's any thoughts of returns to shareholder returns. So I will hand over to Jan.
Great, thanks, Sue. We've got a couple of slides on ESG, which I'll flip over relatively quickly, and then Mo will talk you through the assets. I seem to have gone over 2 slides. Yeah, so this first one shows our overall philosophy on ESG. Whole thing obviously underpinned by an exemplary safety record in Vietnam, 16 years of operations without an LTI. Also strengthened governance, and we're committed to transparent reporting in line with TCFD requirements. We have not as yet come out with a timetable and a plan for net zero, but that doesn't mean that we're not doing a lot of work on it behind the scenes. We've got a study ongoing, particularly in Vietnam, targeting emissions reductions, projects that could be brought in, fuel efficiencies, reductions in flaring and venting, but all of these need to be in line with the status of the kit that we've got, particularly the FPSO, and they need to be cost effective. So during the year, we'll be firming up on those plans and coming back to the market with more detail. This slide just shows the 2021 reported numbers across the ESG framework. The emissions numbers, the absolute numbers, are down on last year, but the intensity is up slightly. We captured for the first time the full scope of the venting that was happening in Egypt, and that's pushed the per barrel number up slightly. Just like to draw your attention to this middle section, business. 100% of the oil last year was sold domestically. And in Vietnam, that's particularly important because they're still quite dependent on coal in their power generation systems. Since COP26 in Glasgow at the back end of last year, they've pledged to remove coal from the power generation systems by 2040. And in doing so, they've reforecast the petroleum use in country, and it's set to double by 2050. So our assets in Vietnam are particularly well placed to help the Vietnamese government move away from coal into more petroleum. That's all I'll highlight on ESG, and I will hand over to Mo on the assets.
Thank you, Jan. I'm Mohammed Said, the Group Head of Technical for FPSO. I've been in the company for 2 years. Before that, 2 years with the private equity and Merlon, who owned the Egyptian asset. And before that, 14 years with BP, different locations, US 7 years, London for 4, and then Egypt for 4. I'm going to go through the slides relatively quickly, just to allow you more time for Q&A. But like Jan said, 2021 was indeed a busy year. In TGT, if I were to point you to the plot in the middle, the top right plot, you can see there is 4 wells. The 4 wells incremental production was about 5,000 barrels. And that just happened before the compressor issue happened on the FPSO. The compressor issue highlighted here in yellow, you can see it was recovered relatively quickly. It went down in November, it came back up in January. It's exceptional time by the operations team. When the 4 wells were all on production, as you can see here on the top chart, the green one, we almost had 17,000. So decent contribution from the new wells. Importantly, also to see on the map on the right, if you can see my cursor, there are 4 well locations highlighted in yellow. They're all in different parts of the field, and all of the 4 wells have contributing meaningful to production. In 2022 for TGT, we have 2 wells highlighted on this map, one in orange in this part of the field, and the other one here also highlighted in orange. There are 9 contingent wells, which are important. I'll pick up on the next slide the importance of those 9 contingent wells, and I think they link to one of the questions in the Q&A. It's always nice to say Vietnam came in guidance, within the guidance range being provided. So TGT is, like I said, 4 wells. Compressor issue impacted the production a little bit, but was recovered in January, and right now we're fine-tuning and improving production. In CNV, the second asset we have in Vietnam is pretty steady year. No drilling in CNV. It focused on routine maintenance and well optimization, so several gas level valve optimization, pressure maintenance, etc. The third component of Vietnam is the Block 125, 126, which is under exploration right now. 2021, we have done seismic survey, 3D seismic survey offshore. That was done on budget and on time. The results of the 3D seismic survey that we've seen right now, as we continue to process the data, are coming up with some interesting geological feature that we're currently evaluating. Going into the next slide to talk about 2022. I'll start from the pie charts, kind of give you an orientation. This pie chart here, it shows the 2P component of the reserves is split between TGT, which is the light green, and CNV is the dark green. It's about 15 million barrel of reserves net to us. The 9 wells I've mentioned in the previous slide is important because they make the part of the contingent resources, which you see in the second bar chart. Again, TGT in light green, CNV in dark green. So without the new wells, those 9 contingent wells, we are currently seeking 2 years of additional license extension. So the current reserves include a customary 5 years extension, which takes us, right now we are 2026, plus the 5 years will take us to 2031. So which means an additional 2 years of reserve extension. The 2 years will give us about 2 million barrel net reserves to us, assuming no more drilling. Maybe just to clarify, the license were to expire in 2024 in TGT, for example. We have been already awarded 2 years, which takes us to 2026. That's the current approval. And then we're seeking this additional 5 years, which takes us to 2031. So there, again, one of the Q&A was about the life of the field. Without any drilling, except the last 2 wells, which we drilled in 2022 that you've seen in the previous slide in orange, we will get an additional 2 million barrel of net reserves to us by this additional 2 years extension. And that is about 1.3 coming from TGT and 0.7 coming from CNV. If you were to include the 9 additional contingent wells in the previous slide, you can monetize a lot of this 2C resources here. You can see a bigger size of the price. So the price here is still fairly large to go after. The 2022 guidance for Vietnam is 5 to 6, which concludes the second slide on Vietnam. I'm happy to pick up on the questions later. And now I'm moving on to the Egypt section. On Egypt was also a busy year, different. We haven't drilled as many as Vietnam, but in Egypt, we have been focused quite extensively on restoring wells on production. As you know, during the hiatus, we've shut down, pretty much stopped all activities, and with stopping the activities, we had a backlog of maintenance. Once we restarted the activity program, we went after it. We brought wells back on production. We have been busy with the waterflood phase 1B program, of which we've raised some of the money for, plus drilling activities. If I were to orient you to the middle top plot, it's one of the 2 wells we put on production recently as part of this campaign. You can see the well tested at 1,000 barrel. The second well below is Narsila D16, which was the first well on the drilling campaign. And again, it tested at 600 barrel. Both of these wells currently on production, and they produce about 750 between the 2 of them. And they have extra capacity. Right now, we're curtailing the capacity to manage how quickly they decline and provide the pressure support. So in summary, for El Fayum, which is the current field, current concession on development, we have restored wells back on production after restarting activities. We've implemented a water flood program, and we've implemented those new 2 wells drilling. There are a few more things I'll mention in the next slide, but we're really going after 3 different components to increase production cheaply and more efficiently. The second component of the Egypt story is an exploration block north Beni Suef, which we're excited about, similarly like the 125, 126. The MBS came in with a pretty good quality seismic survey. We inherited from Apache. This asset used to be with Apache. We've worked it for the last 2 years, and we were able to identify low-cost, low-risk, drillable prospects. These prospects have been identified by us, and now our partners, IPR, see the same potential. I'm going to go to the next slide. I give you the quick update on 2022, MBS and El Fayum, and also talk a little bit about the integration with IPR. Starting with El Fayum, our plan now, the deal has effectively happened. We've announced it this week. So we're going after ramping up. So IPR, we had the first meeting within the JV, the IPR people went in. They're ready and excited to ramp up activity. In the current drilling program, we raised money to drill 3 wells. So we drilled 2, and the third one is currently ongoing. So we finished this one, and we have about 10 wells targeted by IPR to drill. We still have a significant contribution from workover well intervention program, which is split into 2 components. The first component is a recompletion by adding a zone that's not on production to productions, like almost a brand new zone. The second part is through well injection optimization, whether we shut off a zone that has more water, or we add in a new zone that has it has oil, or we convert a high low value well into injector, so you can see the value on the offset producers. The key for delivering the Egypt program and is really access to rigs. Right now, the rig market in Egypt is tight, and that's in a way part of the advantages and disadvantages of the onshore assets. When you see onshore assets, is easy to ramp up and easy to ramp down relatively quickly in reaction to the oil price. So as we are trying to ramp up activities to show the field potential and also capture the high commodity price, other operators are doing the same. So we see a tight rig market in Egypt. Also, Egypt is in a unique position where they send rig equipment and talent to the Gulf area, which is also trying to expand. So for us, the key component around delivering Egypt is the access to rig and also any supply chain interruption, because obviously COVID and the current conflict going on in Ukraine, Russia. On North Beni Suef, we have 2 planned commitment wells. Again, it's in areas we've seen the potential. We think we can see extension of other operator field where they produce from into our concession. We also see some deeper prospect potential. So we have 2 commitment wells, small seismic survey to run, all of which have been identified, most of them on a 3D seismic, which we inherited, and they consider low risk, low cost prospects. The reserves in Egypt is quite significant. That's the second bar chart. You can see around 38 million, call it 38 million of 2P reserves. The dark green is the 2C, which is again, it's a pretty significant component. In the 2C, the amount of wells you need to drill is roughly 60 wells. And then to get to the component of the 2C, you don't really need license extension like you need in Vietnam. It's an additional drilling. So you continue doing, basically reduce the spacing, and you implement the water flood, which will help monetize the 2C. So for us, in terms of technical resources and the operations, we see a clear pathway for monetizing 2Cs to 2P to money in the bank. We've also been running a safe and efficient operation. We ramp up drilling 4 wells back to back safely, efficiently. And when the compressor issue happened, we were able to restore it very quickly. And in Egypt, we've just been going after an extensive maintenance program, restoring wells on production, implementing water flood, and very, very encouraging results of the 2 new wells. By the way, the payout on the Vietnamese wells between 6 to 9 months, and the payout on the Egyptian wells is quite phenomenal, because it's $2 million a well. And right now you've seen the production contribution from the 2 wells is about 750 barrels and $2 million each. So quite phenomenal payout on all the new wells. This is my last slide on Egypt, and I'll hand over back to Jen for a final wrap-up slide, and we're happy to take your questions.
Thanks, Mo. So we've started 2022 in a much stronger position than we were in this time last year. We have a clear roadmap to generating cash and creating value. The oil price is undoubtedly helping, but it's all the actions that we've taken ourselves last year in adding liquidity, changing the terms of the Egyptian license, bringing in IPR as a partner, that are really putting us in a strong position. We've got this solid pipeline, which is underpinned by the robust production, high netback in Vietnam, which has got significantly more to play for with license extensions, as Mo talked about. We've got near-term upside cash generation from the production growth in Egypt set to start now that IPR is really in the driving seat. And of course, we've got the full carry and the enhanced license terms to add to that. And we've got a nice mix of exploration types across the portfolio. All of these are setting us up for the return to positive free cash flow generation. So we're in a much leaner, more focused, stronger position, and looking forward to having returns to shareholders back in our sights sometime this year or early next. And with that, I will stop and hand over back to Paul.
Jan, thank you very much indeed, and thank you to the rest of the team as well for your presentation. Ladies and gentlemen, do please continue to submit your questions using the Q&A tab situated in the right-hand corner of your screen. But just while the team take a few moments to review those questions submitted already, I'd like to remind you the recording of the presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. Perhaps before we go into some of the live questions, we did receive a number of questions pre-submitted by investors, and the company have very kindly grouped those into certain themes. So if I may just start with the first one, which is Egypt. The first question reads, can you clarify exactly what has been achieved in terms of tangible results with the $11 million that was hastily raised from shareholders last year at a significant discount?
Can I start with that? Mo will answer the technical side of it, but it is a when did you stop beating your wife question, because it by no means was a hasty move. You know, we were 10 months into the downturn, and it was something that we had been considering since probably the previous summer. If we could have avoided it, we would have, because raising equity is not something that anybody likes to do. And the point about being at a significant discount, yes, to the share price where it is just now, but maybe the share price wouldn't have got to these levels if we hadn't actually done it. So Mo, the technical answer.
Right. As Jen said, the technical answer is straightforward. We raised the money to drill 3 wells. We drilled 2, and you've seen the results of the 2. We have implemented water flood in the northeast Tirsa, which is also a new area. We have 6 new wells brought back on, not new wells, but 6 wells brought back on production in the areas of the water flood. We had 1 well conversion to start water injection, and basically some surveillance monitoring. So this is the exact number of the different component of that water flood program. The fact that we started that water flood program and the restoration of production, the drilling, these key activities, I would say had a very positive outcome on the farm out process. So again, the potential of what we've done so far is proven to IPR and other people we were talking to through the farm out process, the significant potential in El Fayum.
Fantastic. Thank you, Mo. Thank you, Jan. Next one we have here is, how much sensitivity analysis at low oil prices did PHAROS do on the Egypt acquisition? How prepared were you for the low oil prices? Was there a plan B if oil prices dropped below the $45 per barrel break-even price?
So I'll pick that one up. The $45 break-even was a much later break-even. If you look back to the slide deck from October 2019, 6 months even after we had acquired the assets in Egypt, the life of field break-even at that point was still calculated at NPV10 at $34. It's slide 77 if you want to go back and check. And at that stage, it seemed ridiculous to go below that level to have a plan B. It's one of the reasons why break-evens are useful, but they're not the only metric that should ever be used in evaluating any project, and particularly when you're right at the beginning stage of a development. So many factors can change the cost base, the production levels, the discount rate, to impact on the break-even, that other metrics were used as well. But at the time that we acquired the asset, we were nowhere near the $45, and so didn't think that plan B was needed. Clearly it was. Hindsight's a great thing, but that's the way it was at the time.
Fantastic. Thank you, Jan. Next question we've got is, does the company regret shutting down drilling operations in Egypt since 2020, or should PHAROS have continued drilling in Egypt, even with 1 rig, to prevent oil production rate falling off the inevitable cliff?
I'll pick this one up. I think the basically the COVID was very unpredicted situation. We haven't seen this one before. We have ramped down activities. Ideally, yeah, you would have a rig, one drilling rig, maybe one workover rig, or just one of them, but you want to have something going on. That would be the ideal situation. But because it was unpredicted and seen most of us have seen oil going into negative and much lower oil price, and we wanted to preserve cash and being able to sustain the company future, other operators in the area have done the same thing. So in an ideal scenario, yes, you keep a drilling rig and a workover rig, I would say, not just one drilling rig, one and one at least. But the situation was far from ideal. However, what this situation allowed us is just give us that ability to negotiate the commercial terms with EGPC, which helped on improving the overall life of the field economics. So maybe we have lost something on the short term, but we've gained something bigger on the longer term. So that's one. The last point I want to raise is this asset, El Fayum, and most onshore for that reason. They go through stop, start, and the company that owned the asset before have done something very similar during the Egyptian revolution when they had to shut down all activities and the production drop was inevitable. But we were able after that to bring the production back up. And several cycles, if you go back and review the asset history, you'll see that it goes up and down. And again, part of the format and part of what we wanted to do all along is to continue that ramp up of activities. And if you look at forest production in the quarter one of 2020, when we had 3 rigs drilling, which is exactly the plan we wanted to do, month on month, we were adding 200 to 300 barrels, and our production was on a steep upward projection. We hit 7,000. If we had not stopped at COVID, we could have been now at a much different production levels just by implementing consistent drilling program. So the asset potential is function of the investment. That's what why we brought IPR. They believe in the same thing. And yes, like I said, the short answer, ideally, yes, you keep one drilling rig, one workover rig, but we've managed through the situation like all other operators in the area. And now we're into a period where we see the production potential increase again from the asset as we implement the drilling program.
Well, thank you very much indeed. Next cluster of questions around Vietnam. The first one reads as follows. With regard to the TGT field in Vietnam, the contract for the FPSO charter ends in November 2024. Given the 4 additional wells drilled in 2021 and 2 more in 2022, are the Vietnam partners seeking to extend the FPSO contract?
Do you want me to pick that one up? So absolutely, there's conversations ongoing with the FPSO owner, and contractually we're in a really strong position. The deadline for the owners renewing the contract is April 2024, and they have no right not to renew that. We need to ensure that all the right safety considerations are taken into account as we do that.
Fantastic. Thank you, Jan. Next one we have here is what is the remaining life of the TGT field as seen as presently?
Yeah, I can pick this up. Like what I've tried to answer this in the slide section. So we have now until block 16.1 TGT until 2026, and CNV until 2027, with the 5 years extension takes it to 2031 and 2032 as we see it now.
Thank you, Mo. The final Vietnam question we have is why is the company only drilling 2 TGT wells and only 1 CNV well this year? Isn't now the time to be more ambitious and aggressive with the drill bit? If we can't drill more than 2 to 3 wells per year when the oil is $120 a barrel.
I can again. It's a good question, and yes, but the budget is set up a year like in autumn, and we have there is long lead item. There are things that you need to plan for, and if you follow the industry, for example, subsea or wellheads are very hot commodity right now, difficult to acquire. So the planning part takes time. So we budget in the autumn of last year. We've managed to drill, or we will be able to drill the 2 wells before the end of the year, which will conclude the 6 wells already approved on the full field development plan, the current version. And then what we've been doing in parallel is to accelerate the full field, the next version of the full field development plan update, which is nearly done. And that would allow us, based on the results of the previous drilling, the extension, extending the license, and it requires that updated full field development plan, which in it you can see the way to monetize those 9 contingent wells. So some of those wells will be part of that revised full field development plan to go after drilling. So really drilling, as you know, it requires front-end loading planning. You're drilling offshore in a time where commodity prices up. So there are competition, not just simply put money on the drill bit.
That's great. Thank you, Mo. Next question has got around share price. Why do you think our share price performance has significantly lagged our London-listed oil peers year after year since 2016? Are there any reasons you can pinpoint, and is there anything the company can do about it?
Okay, so I'll pick this one up. I mean, if you look at our price to net asset value, we're sort of mid-60s%. There are companies with a lot lower, there are companies with a lot higher. So, you know, we're not a complete outlier. I'm going to answer the question in 3 parts. The first is we have got quite a different register to most of the smaller end E&Ps. We've got a number of significant holders in the high net worth category, sort of 8 to 10%. And that flows through into a lack of liquidity in the stock. And that's always cited as an issue, but it's also a strength. And for example, those high net worth individuals came through really strongly, providing support for the placing last year. So that's the first part. The second part is, I don't believe that you should run a business purely with one eye on the share price the whole time. You run a business for fundamentals, and if you get them right, then other results should follow. It's one of the reasons why we've changed our management incentives, which were previously very solely focused on share price. We've now included a number of business fundamental measures in there, return on capital, cash generation, to add to the share price. And the third part of the answer, I would say that this picks up on another question that's come through as we've been on air, and that's to put back a clear policy on returns to shareholders. We have had no capital to allocate in the past couple of years. As we move into free cash flow generation, allocating that capital and the role that returns to shareholders has in that return, in that capital allocation, is going to be really important. The more visibility we can give that, the better. And you should expect to see something about that this year. Now, the question that's come through is, what metrics will we use to guide the amounts to return? Is it going to be regular dividends, one-off dividend, share buybacks? And this is something that the board is looking really carefully at the moment. All I can say at this stage is it is definitely going to be a more regular pattern rather than one-off dividends. But we can see merits in both dividends and buybacks, particularly when you look at the PNAV that we just talked about. So we'll be looking at that really carefully before we come out with any definitive statements.
That's great. Thank you, Jan. Next question is around M&A. Are the company currently interested in acquisitions in Southeast Asia? Is M&A something in the short to medium term on the agenda?
So again, we've hopefully demonstrated in the presentation that we've got a really good balance right now between organic growth potential in the portfolio and the funding that we have available to make the investments to bring that potential out. So that's the short term. In the medium term, let's see how things go, particularly in terms of where the oil price sits this year, next, what the cash flow generations look like, and we'll come back to that if we need to.
Thanks, Jan. The next question we have on here is around Merlon. kind of two questions that encapsulate each other, I guess, but I'll read both of them out and we can bring them together. On a scale of 1 to 10, 1 being we have no regrets and 10 being we deeply regret, how much does the company regret buying Merlon? And just in a follow-on to that, in a recent video, Ed Story, outgoing president and CEO, said he'd learned 2 lessons from the Merlon acquisition. 1, things take a very long time in Egypt, and 2, never buy anything from private equity. Does Jan Brown agree with him on the above, or does she have differing opinion? Do you think other lessons, perhaps different lessons, have been learned from the Egypt acquisition? Sorry, quite a lot to throw at you there in 3 parts, but
Okay. So on the first part, I'm with Edith PF, no regrets, they're not helpful to anyone. Let's stay constructive. It was the right decision at the time. And if the oil price in 2020 had been where it sits right now, we would be in a very different position. So moving on, Ed's 2 comments, things take time in Egypt. Well, they do, but I've never known a jurisdiction where they don't take time. I mean, in the UK, you want to do a shareholder circular to get approval for something and it'll take you 6 to 9 months. So, you know, Egypt is not unique in that. That's part of our job, to manage the business while we're waiting for approvals. On the private equity side, I completely understand why Ed said this, because fundamentally we saw a level of production when we signed the deal with Merlon to acquire the assets. And between the time that we signed it and the time that we bought it, investment stopped. And so the production levels when we actually completed were significantly lower. But if you look at, we had already walked away from another deal, which was not private equity owned, for exactly that reason, where we could see that the governance structures in place gave no guarantees that the business that we would acquire at completion was going to be in the same state that we were looking at before signing up. So I don't think it's a private equity feature. Private equity is not a monolith, and equally there are a whole range of ownership structures which give that. And that's the protection of being in a premium listed environment, because the disclosures that are required of us mean that we're constantly having to be public about what we're doing. So the lessons learned, I've said no regrets, absolutely, but you've got to learn lessons from what went on. And fundamentally, PHAROS went from being a company way back 2017 with quite a lot of cash and absolutely no investment opportunities. Even Vietnam was closed off at that point in time. It went from that to having no cash and a wealth of investment opportunity in 2020 after the crash. So what we've got now, as I said earlier, is a balance. We've got the opportunity, we've got the funding, so let's move on, bring them together and see what we can create.
That's fantastic. Thank you all. That does conclude the pre-submitted questions. Merlon, if I may just ask you to step in, please, just for the live Q&A, and where appropriate to do so, if I could ask you just to read out the question, even who it's from, and just direct it to the team, and we'll pick up from you at the end. Thank you.
Great, thank you, Paul. I'm going to go through the Q&A, the questions that were submitted in the Q&A tab. There are quite a few number of questions, and I'm aware we don't have that much time, so I do apologize if we are unable to go through every single one of them today. And also, quite a few of them were already addressed in the previous Q&A session or already been addressed during the presentation, so I'm just going to skip them. The first is from Matthew R. Can you expand on your cash operating costs and where do you see this going forward?
Yeah, I can pick that up. Thank you, Merlon. Yeah, so our cash operating costs last year, 52 million for Egypt and Vietnam. We paid a wee bit more in Vietnam because of the FPSO, which I explained earlier, because we had more throughput than Thong Long, who we share the facility with. They have actually drilled a well and is expected to come on and clean up, etc. So we don't have full visibility of that yet, but you know, as being a conservative person, I would stick with the costs that we had in 21 as being a reasonable position go forward.
Great. Thank you. A question from Keith P. You referred to some interesting structures on 125. Are you able to indicate any more details?
One for Mo, I think.
Okay, so the interesting structures, I think the key, there are several of them have been identified. Okay, and if you, I don't know how much you know about 125, but there has a shallow water element and has a little bit deeper water element. So several different types of things that you can drill on 125, 126. The reason I identified them as several interesting geological feature is the 3D hasn't fully finished yet. And if you know a little bit about the subsurface, you do the 3D, you identify the prospects, and then you probably drill a well, which we plan to drill a well on in 2023. Okay, and until we get the second layer of the final 3D interpretation and better understanding of the different geological features and where we recommend to drill the well, I will leave it at an interesting geological feature, but something that we've seen similar in different places and we think that has a pretty decent potential.
Thank you, Mo. The next question is from Mark L. Given the current structure of the business and capex commitments, what is your view of the right amount of hedging to have in place over the next 1 to 2 years? Is it 25, 50%, or higher of annual production? And a similar question to that, Keith P. asked, what approach have you taken to hedging during recent price spikes? Have you locked any of the high price in?
Yeah, no, they're all interesting questions, and obviously it's a very interesting field. It was the hedging that kept our heartbeat going in 2020, and obviously last year, 21, we had sort of the reverse of a payback almost. So as I've mentioned earlier, the RBL requires us to hedge 35% of our Vietnam production. As I say, the RBL is only over Vietnam production, so that probably is the maximum that we really want to hedge. You know, it's sensible, you know, to try and keep some of that free float in there so that we can take advantage of the prices, etc. So as I say, we're higher hedged at this first half 22 than we probably like to be, but that's because we do fairly heavy stress testing on our working capital and going concern tests, etc. So hopefully that answers your question.
Fantastic. Thank you, Sue. And I think we have time for one last question from Robert R. Widge, who asked, who pushes the company, who sells the company to new institution and larger investor in this exciting time for the business?
So Minan's not read out the whole thing. I'll read out. We have the defenders and goalkeeper. Do we need a centre forward? And I guess my answer to that is, if you're looking for a Ronaldo, then no, I don't think we do need that. Look, that's one for the nomination committee, not for the executive directors. It's our job to go out and push it together. We're a team, and so far so good. But I've only been in the seat for 4 days. There is another question that came through in the pre-submitted, and it was about Investor Meet Company. So maybe they've just been very reticent about mentioning it. And look, it's our intention to carry on using Investor Meet Company. We've reduced our cost base, reshaped our costs quite significantly, and we see this as a really efficient way of reaching the retail part of the register, which is about 4%. You know, that's a reasonable chunk of the company. It's really important for us to be able to provide access to all our shareholder base, and the intention is that we provide guidance for Egypt in May, around about the time of the AGM. And we would hope to have another session if there's enough interest then, because that's the next really important milestone for the company, to see how we pick up and develop out that Egyptian base with IPR as operator.
Thanks, Jan, and we very much look forward to hosting you then. That does conclude all the questions, so thank you very much indeed. And of course, if there are any further questions that are submitted, the team will have the ability to review those questions and with public responses where appropriate to do so on the Investor Meet Company platform. Jan, just before we redirect investors to provide you with some feedback, which I know is very much important to you and the team, if I should ask you just for a few closing comments, please.
Sure. So I've said this earlier in the presentation, but we really are in a very different place in 2022. We have got the organic growth potential in the assets, both in the near-term developments, but also in low-risk, low-cost exploration in Egypt and a potential basin opener in Vietnam. So this wide range of exploration as well. We've got the funding to deliver the growth, and we do have the team. We're leaner, we're more focused, but we're ready to deliver and get back to free cash flow. So we look forward to the next piece of news flow in May, and that's our story right now.
That's fantastic. Thank you very much indeed, Jan, Mo, Sue, Minan. Thank you indeed for updating investors today. Could I please ask investors not to close the session, as you'll be automatically redirected to provide your feedback in order that the team can better understand your views and expectations. This will only take a few moments to complete, and I know is greatly appreciated and valued by the company. On behalf of the management team of PHAROS Energy PLC, we'd like to thank you for attending today's presentation. That concludes today's session. Thank you and good afternoon to you all.
Thanks, guys.